So we move on. We have provision for bad debt. In the previous note, the provision for bad debt was we have for building. Okay, for provision for bad debt, they said provision for bad debt is adjusted to 5% of debtors. 5% of debtors. So what's our debtors? Our debtors was 34,600, right? So 5% of 34,600. 0, 0, 0, 0. 5 times 346, what's that, please? Take your bag away from there, put it on the ground. 5 times 346. Close that textbook immediately. Close that textbook. Close that textbook. Close it. 5 times 346. What does that give you? 1,000? 1,710. Now take it away from this. 30. Now take it away from this. 3,000 minus 1,730. 1,270. So what does this simply mean? So before now, the provision for bad debt was 3,000. It has reduced to what? 1,270. That's reduction. Decrease in what? Decrease in provision. So because it's a decrease in provision, it becomes income. What do I call it? What do I call it? Income. So you will treat it in your profit and loss account as income. If it has increased, it is an expenses. If your provision for bad debt increases, it's what? Expenses. If it reduces, income. Do you understand that, please? You're chewing gum. Get out of the class already. Provision for bad debt was 5% of debtors. This is your debtors. Money. The new provision should be 5% of it. Our new provision is 1,730. The old provision was 3,000. Old minus new gives us the expenses or income on provision for that bad debt. But before now it was 3,000, now it's 1,730. It has reduced to 1,270. So this is an income for the business. So you treat it as income, yes?
What if
your question here?
What if it's more than 1,730? If it's more than 1,730, that means it's increased, right?
If it is, right now it is one, if it is more than 3,000.
It's more than 3,000.
It's not more than, what we need is anything less than 3,000. Anything less than 3,000 is an income. Anything above 3,000 is an expenses. Both of them are going to be treated in the profit and loss account. They are items in the profit and loss account. But one, when it decreases, it's an income. When it increases, it's an expenses. I think that is clear. Now we go on to depreciation. They said building 2% of cost, motor vehicle 10% of NBV, office equipment 25% of cost. That's how we're going to get this year's depreciation. We need to know this year's depreciation, which is an expenses. So the first one is building 2% of cost. Building is 600,000. This is the cost of building. They said 2% on cost, so it's going to be 600,000 multiplied by 2 over 100. What does that give you? 12,000, right?
Yes.
12,000.
Yes.
12,000. So this is this year's depreciation. But building does not have existing depreciation because building would not depreciate. Building would rather what? Appreciate. What do I say? Building would what? Appreciate. Do you get my point here? So building doesn't have existing depreciation. So it means our depreciation is 12,000. Do you get that?
Yes.
The second one, motor vehicle. You don't just treat motor vehicle, you go back to the additional information on what they said about motor vehicle. They said motor vehicle 10% of NBV. What's your net book value? Depreciation minus accumulated depreciation. That's your NBV. Yes or no? So here we have 80,000 minus 15,000 multiplied by 10%, right? 10 over 100. Do we get that?
Yes.
Do we understand this? So 80,000 minus 15,000 is what? 65,000. Right?
All of them together, 78,500.
78,000.
Yes.
Divided by 100. Did you divide?
Yes.
No, something is missing. This is 80,000 minus 15,000, that's 65,000, right? 65,000 times 10, that's 650,000. 650,000 divided by 100, that should be 6,500.
80,000 minus 15,000 is 65,000.
Yeah, 65,000 multiplied by 10 over 100, right?
Yes.
6,500. 6,500. Yeah. So 6,500 for this year. Now we have existing one. Yes or no? 6,500 plus 15,000 is what?
Plus.
Yeah, with plus. This is your existing depreciation. This is this year's depreciation. You add them together.
21,500.
21,500. Do we understand that, please? You're writing. You will tell me what you are writing afterwards, okay? So we move on. And the last one.
So why then you put
This one?
yeah.
21,500.
Then I said I
Let's go back to the question, the additional information. Depreciation should be 10% of NBV for this year. Net book value is cost minus depreciation, right? This year for motor vehicle is, the cost of motor vehicle is 80,000.
That's the net.
Sorry. The cost of motor vehicle is 80,000.
80,000 is the net book value.
No.
It's
The cost, historic cost. NBV is depreciation minus, cost minus depreciation. So for this year, we have 80,000. There's existing depreciation, right? For 15,000. We need NBV. NBV is cost minus existing depreciation. So cost minus existing depreciation is what we're going to take depreciation for this year on. So for this year, it's going to be 18,000 with the existing depreciation, which is 15,000. So the cost of assets this year is 65,000. We bought the asset. It has been depreciated by 15,000, existing depreciation.
Of course, it's 6,100.
65,000. The cost of the asset this year is 65. And that is where you're going to get your depreciation from. But remember, there was depreciation for last year, plus depreciation for this year, that's accumulated depreciation. Why we don't have accumulated there is because there's nil here. We're supposed to add this and this together, but it's nil.
What does that mean?
Nothing irrelevant left.
So there's no existing depreciation.
There's no, yeah. So it's 12,000. 12,000 plus 0 is 12,000. Now 6,500 plus 15,000, 21,500. Do you get it now, please? Then we have office equipment. The office equipment at cost is 25,000. They said office equipment is 25% of cost. Go back to your case study. There is 10,000 already for existing depreciation. It's part of it. How do we get that? 25,000 minus 15,000. In your notes, they said cost is 25,000 and there's expense of 15,000. So cost minus expense gives you 10,000 existing depreciation. And that's how we got the 10,000 here. Do you get that? So now we have 25,000 here. And it's all about 25%. So it's going to be 25,000 multiplied by 25 over 100. What does that give you?
6,250.
Are you sure?
Yes.
6,250. So add it together, that's 16,250. Any question about that? So we have the last one, which is drawings. Stop writing, please. For drawings, remember yesterday we talked about drawings. What do I call drawing for you? What is drawing? Is an expenses? No. Is an expenses for who?
For the business. For the person.
For the owner of the business.
Yeah.
So when the owner of the business takes money from the business, it's drawings. There is expenses on the private house of the owner, Joe. So that was 400 yesterday. Remember that? So the total drawing was 14,000. The total drawing was 14,000. Now there is an expense on the owner of the business which was 400. So we had it together, which goes to the balance sheet. Do you get it or not?
Yeah.
Drawing is an item in your balance sheet or your statement of financial position. But the drawings we have previously, when you check your trial balance, it's 14,000. Now we have insurance on the house of the owner of the business, which is Joe. of 400. So our drawings will be plus 400, which is now total.
Wait, how do you know it's 400?
We did it yesterday, 14,000. 14,400. That's the total drawings now. We did it yesterday.
Yeah.
On house, we have expenses, insurance expenses. Check your note, please. Oh, you didn't write it, okay. So we did it yesterday on insurance. So the 400 will be added to these drawings. So that's the total of drawings. So what is left is going to be part of expenses in the profit and loss account. So insurance in your profit and loss account would have deducted 400 off it. So this is the last adjustment. Then we prepare the profit and or the final account, which is the statement of profit and loss account. We're going to prepare that now. Please start there. I have it here.